Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. The big question of the day is how should investors position themselves in this bearish market? I speak to Chan Han Chin, our portfolio strategist, whose regional team recently published a new report, The Calvary is Not Here Yet. So Han Chin, what does this title mean?
Why we say that is because what we are observing currently is that the Fed is basically raising interest rates in a bear market. While opposed to what we observed in the past, in a bear market, usually what you see is that the Fed is cutting rates. So what's happening right now is that because of the inflation pressure, it is forcing the Fed to be very committed in fighting inflation, and growth will not be on their agenda until this inflation is sort of stabilized. And even though there are already initial signs of success by the Fed in bringing down these long-term inflation expectations, it is still high based on historical standards. So we don't see that Fed being able to abandon its current hawkish policies to shift back to balanced growth, to more growth-oriented policy. This will not happen until we see further signs of stabilization in inflation.
Do you think we've seen the worst yet? Has the market priced in all possible rate hikes by the Fed and even the possibility of a recession or hard landing?
I think markets right now would have understand that Fed is really committed in its rate hike to fight inflation. So if we say that the market has not factored in the rate hikes, I don't think so. Markets understand that. Right now, they understand that the Fed is very committed in fighting inflation. As if you compare to 6 months ago, the markets would not have probably believed that the Fed is that committed. And if we look back into data since year 2000, there were only 3 times that the S&P 500 fell into a bear market. And it all happened during and around the past 3 recessions. All these bear markets, they have averaged a loss of about 40%. And what we have currently, we have not fallen into a recession yet, but we already fell into a bear market. The losses are about in the lows of 20%, which is sort of an indication that markets are fairly pricing in maybe a 50-50 chance of a recession, or that markets are already pricing in a sort of a mild US recession. And whether we have seen the worst yet for the S&P 500, of course, an easier answer to it would be if US eventually falls into a recession, of course, we are likely to see further downside from here. But if it does manage to avoid a US recession, then I think the current valuation is actually quite compelling already. But I think also another more important issue is whether the Fed will be successful in bringing down inflation quick enough so that they can give back the focus to growth.
So this is quite interesting. There are a few themes going on here. So one is economic growth. In the first quarter in the US, GDP growth shrunk, but yet there's a consensus view that I think second quarter that it will grow 2.5% to avoid a technical recession. At the same time, it seems like it takes a lot to engineer a reduction in inflation rates from 8% to 2%. But yet, if you take a long historical view in the US from the 80s, the current interest rate comparatively low. Is the market overreacting?
I don't think that the market is overreacting. Yes, interest rates may have been much higher in the past. We have come down from very high interest rates, and slowly it has been coming down, and it has never gone back to the kind of interest rates we see in the past. Because in the past, also to mention, in the past, I think private debt in the US, it was not as high as what we observe currently as a percentage of GDP. So in general, people have been accustomed to a low interest rate environment. And people, humans have adapted along the way. So now we are more adapted to a low interest rate environment, and all these there are financial excesses which have been built up in the system. So we can no longer tolerate going back to the very high interest rates that we have seen in the past.
What are some signposts that you will look out for to indicate that the markets may start to normalize, if there's such a thing?
Yeah, I think the basically like what you mentioned just now, the inflation, it takes a lot to engineer a reduction from 8% to 2%, because as we know, when we every time we look at the inflation numbers, it looks very scary on the media when you see like inflation is at 40-year high. I would think that all this is more on a short-term basis. I think we like to monitor the longer-term basis on a more longer-term basis. So one of the things that we look out for is the US 10-year inflation break-even, which basically indicates what is the long-term market expectations of inflation, which is implied from the bond market. And to us, if these numbers stabilize more convincingly, and also it comes down it has currently come down from its record high. So this sort of indicate that the Fed is has some initial success in taming the long-term inflation expectations.
What rate would you be looking at?
We actually base all of this on historical numbers. So we look at the past 20 years, and we think that a number above above 2.3, 2.4% is still considered as quite high based on historical standard. Right now, it has actually come down quite a lot to about 2.5% right now. So that's why there's also one of the possibility that we may be observing some of the some short-term rally in the markets.
In your report, the Calvary isn't here yet. You are favoring quality stocks, and your view is that they offer the best risk reward and will lead to the next rotation trade. So my impression that this call is based on a flight to safety. Could you explain and what drives your assumptions?
Last year and this year, we were positive on value versus growth trade. The value versus growth trade has generally been doing very well. And this is because value generally it performs well under an inflationary environment, but it performs best when it is also accompanied by high growth. But as we all know, with the risk of a US recession rising, revisit the scenarios where we look at the performance of all these different styles under different kind of growth environments, assuming that inflation stays high. So what we find is that when we move from a higher growth environment to a more moderate growth environment, quality becomes relatively more attractive and value becomes less so. And there's also another reason why the risk reward has actually turned much more favorable for quality. This is really due to what happened over the past 1 year, where you see there's an indiscriminate selling in all stocks with high valuations. So this has affected growth, and it also has affected quality stocks quite negatively. And since that now valuations have come off from its high and down to more reasonable levels, I think the opportunity is certainly there to buy all these high quality stocks, which will then perform better under a lower growth environment.
Quality stocks have high ROE or return on equity, low debt to equity ratio, and low earnings variability. And you are advocating for investors to switch out to our quality model portfolios. And what stock stands out for you?
We are basically favoring a switch from the value model portfolio to a quality model portfolio. If I were to really pick a stock, I would pick a name that everyone is very familiar with. It is Microsoft. It is also under our model portfolio picked by our team. Why I think Microsoft is good? Because I think I consider it right, considering that it's a company which has sustainable earnings, and its valuations have come down quite dramatically from its high. I think a drop of about 30%. And also, it actually pays a dividend, even though it's not that high, about 1% yield. And another thing is its business segments, in my opinion, they are also less sensitive to the economic cycles. It is second biggest cloud service provider, and it is also pushing into gaming very strongly. In the past, it has delivered strong returns to shareholders. With strong return on equity, it has strong cash flows and good margin. So Microsoft would be my top pick lah, if I have to pick one.
Well, thank you for your time. That was Chan Han Chin, Portfolio Strategist at Maybank Investment Banking Group. I'm Noelle Lim on ASEAN Speaks by Maybank.